Hello everyone, Professor Christensen here. Today is all about depreciation. So this video is going to cover depreciation using three different methods: the straight line method, a units of activity method, sometimes called units of production, and double declining balance. Now, if you don't really know what depreciation is in accounting, there is another basic video that you can take a look at of mine, which is depreciation and only looks at straight line. So today we'll look at all three methods. Now on your screen you see some reminders. So in case you forgot or you didn't know, here's some terms that we want to define. Book value. Now book value also has other meanings. So you might think book value means what an asset is worth. So for example, the book value of your car. But in this case, in accounting, book value has a different meaning. Okay, same word, different meaning. Meaning is cost, the cost of the asset minus the accumulated depreciation to date. Okay, that's what book value is. Depreciable cost, sometimes called depreciable basis, is the cost of the asset, again, minus residual value, which is also called salvage value. So that's the amount that you think the asset's going to be worth at the end of its life. And the depreciable cost, so you depreciate the amount of the asset minus the cost of the asset minus the residual value. And then finally, the depreciation journal entry. It's an adjusting entry that companies make at the end of every period. They're going to debit depreciation expense, that's an operating expense, and they're going to credit accumulated depreciation, and that is a contra asset account that reduces the value of the asset. Okay, contra asset. All right, so let's get into our three examples here. Okay, so first, here's our data. January 1st, year one, a company purchases a truck for $100,000. Estimated to have a useful life of 5 years and a salvage value of $5,000. The truck is expected to be driven 100,000 miles. All right, so let's depreciate this asset using three methods, starting with the straight line method. All right, so here I have a little note about what the straight line method is all about. It results in the same amount of depreciation each year, is the most common method of depreciation. Okay, because it's very simple. All right, so your depreciation each year is your cost minus your salvage value divided by the estimated useful life in years. Let's add in years to this. Okay, estimated useful life in years. Okay, when you depreciate partial periods, so in our example, we bought the asset on January 1st. If you bought the asset, say, on October 1st, then you would take depreciation for the first year, October, November, December, you would multiply the number that you come up with by 3/12. Okay? But this example is January 1st. Okay? Just so we can cover the basics of depreciation. All right. So, what we just said, cost minus salvage divided by estimated useful life is how much we depreciate every year, right? So here we go. So let's find our depreciation for the first year. All right, it's equal to cost minus salvage value. I'm going to put those in parentheses because I'm going to have to divide, so we don't want to get our order of operations mixed up. Cost minus salvage value divided by useful life. Okay? All right, $19,000. So our depreciation expense in the first year is $19,000. Our accumulated depreciation at the end of the first year is also $19,000. It's the same. And our book value, remember what we said about book value, cost minus accumulated depreciation. So our book value is equal to cost minus accumulated depreciation. Okay? Let me just format these so they look better on the screen and you can see the... Okay. All right. So our first year, over here I have a little T account for accumulated depreciation. Remember, it's a contra asset account. So remember, we debit depreciation expense, credit accumulated depreciation every year. So our entry for the first year is 19,000, and that's the only entry we have in there. So our balance at the end of year 1 is 19,000. Okay, now the beautiful thing about straight line is that it's the same every year. Okay, so our depreciation expense is going to be exactly the same every year. All right, so every year we have a full year. We're going to take $19,000 of depreciation. Now, what happens to our accumulated depreciation every year? Well, our accumulated depreciation is equal to our accumulated depreciation from the prior year plus this year's depreciation. Our accumulated depreciation from our prior year plus this year's depreciation. So in this case, remember, straight line is very simple. It's going up by $19,000 every year. So our year 2 depreciation expense is $19,000. And what happens to our accumulated depreciation? We could see it here. It's last year plus this year. It's $38,000 at the end of year 2. All right. On your balance sheet, you're going to show the book value. Remember that the book value is equal to cost minus accumulated depreciation. So notice what's happening here. Notice our pattern. Our accumulated depreciation is going up every year by $19,000. Our book value is going down every year by $19,000. Okay? All right, so at the end of year 2, that's what things look like. Now, in year 3, our accumulated depreciation is the end of last year's accumulated depreciation plus this year. Okay? So now it's $57,000. Our book value is equal to $100,000 cost minus accumulated depreciation. So now our book value is $43,000. Remember over here, let's put in our depreciation for this year, and we can see that our accumulated depreciation is now $57,000. Okay? And our book value, and this is the amount shown on our balance sheet, okay? The cost minus the accumulated depreciation, again, went down by $19,000. Okay, so hopefully you've got the pattern here. Our accumulated depreciation this year is last year plus this year's depreciation. Our book value, cost minus accumulated depreciation. Again, over here, our depreciation for the year, $19,000. Our balance at the end of the year, last year plus this year, $76,000. Okay, now in our last year, we have accumulated depreciation, same, last year plus this year, up to $95,000. Our book value is equal to cost minus accumulated depreciation, or $5,000. We put our annual depreciation here, and we see that our accumulated depreciation is $95,000 and our book value is $5,000. Okay, so maybe you noticed something. What happened at the end of the 5 years? The book value at the end of the 5 years. Now, of course, these are textbook problems. Everything is happening according to plan, so everything went according to our estimates and went perfectly, which is okay. Our book value is equal to our salvage value, and that is not a coincidence. Okay? So at the end, book value equals salvage value. Okay? Oops. It's not liking that because it's looking for a formula. Book value, I should have made that text, but you got it. Book value is equal to, book value equals, let's write it out, that'll like it better, salvage. Okay? At the end of the 5 years, book value equals salvage value. All right, so it's $5,000. Okay, so that's straight line depreciation. That's the simplest one. We have the same amount of depreciation expense every year. Reminder, our accumulated depreciation goes up by the same amount every year. Our book value goes down by the same amount every year. Okay? All right, next up, let's look at the same example using an activity method. Okay? Let's just go up here. Okay, so sometimes your book might call an activity method units of production, units of activity, something like that. The idea with this is that the depreciation is based upon how much you use the asset and really doesn't have as much to do with time as usage. Okay? So notice our depreciation, so we're going to do two steps here. Depreciation per unit, which is cost minus salvage, divided by the estimated useful life in units. That gives us our depreciation per unit. And then for any period, you just take that depreciation per unit and multiply it by how many units were used that period or produced. Okay, so depreciation per unit is equal to, again, we're going to do cost minus salvage. So cost minus salvage. Remember, that's called depreciable base or depreciable cost. But now we're going to divide by estimated useful life in units. Okay? All right, so we're not concerned with years. We don't care how many years this asset lasts. We want to know units. So our depreciation per unit is 95 cents. And actually, in this case, let's make it more accurate. Call it depreciation per mile because this is a truck and that's what that is. Okay, it's miles. All right, now we have our depreciation per mile. Be careful, sometimes students get confused and they put 95 cents. Obviously, that's not your depreciation for the year, right? That number's too small. So our expense each year is equal to our depreciation per unit times the number of units that we use during the period. So the number of units we used in the first year, here are our miles driven, 15,000 miles. Okay, so let me fix this again. Okay, okay, this way everything will look better. All right, so at the end of the first year, our accumulated depreciation is $14,250. Over here, let's put it here, right? Our accumulated depreciation is $14,250. How much is our book value at the end of the first year? It's the cost of the truck minus accumulated depreciation. All right, so at the end of the first year, our book value is $85,750. Okay, next up. Now, in the second year, we drive the truck 20,000 miles. Okay, by the way, over here, we're driving it again 15,000. So over here, I can just put this equal to that because we know it's going to be the same calculation, right? Okay, so for here, depreciation per mile times the number of miles we drove. That gives us 19,000. How much is our accumulated depreciation? It's equal to last year's accumulated depreciation plus the expense for this year. Okay? Our book value is equal to cost of the truck minus accumulated depreciation. So over here, we're going to put in our depreciation, and this is equal to that plus that. Okay? All right, so let's keep going. We're going to follow the same pattern. You know, if you take a screenshot and you want to stop the video at any point and practice yourself and come back and make sure that you did it right, that would be great. Okay, so here's our expense again, depreciation per mile times miles driven. This is equal to last year's accumulated depreciation plus this year. And then again, this is equal to our cost minus accumulated depreciation. I'm going to put our expense over here for each year. Okay. And then our last depreciation calculation, again, 95 cents, this time times 28,000. Okay. Our accumulated depreciation, last year's plus this year, and our book value. Now, in this particular case, if you add up, let's do total miles. So let's do a sum of all of the miles we drove. All right, it happens to be exactly 100,000 miles, okay? Unlikely in real life, of course, but in this case, it's exactly 100,000 miles. So that means, what do we know? Our book value at the end of these 5 years should be exactly equal to $5,000. Okay? All right, so here we go. 80,750 plus the 14, and our book value is equal to the $5,000 again. Okay? Let's put these in here. Our expense each year. And this one, and then we see that our book value at the end is 5,000. Now, if you're going along and doing a problem and you don't have exactly 100,000, then make sure you don't depreciate below 5,000, below the salvage value, okay? Remember, at the end, book value should equal salvage value. You may be able to depreciate it another year. You may go into year 6, which is okay if you drove it less than you thought. If you drove it more than you thought, then in this last year, you're going to have to force this to come to $5,000. Okay? So whatever number you need to bring it up to the number that will give you book value equal to salvage value. Okay. All right. So those are 2 methods. Now, let's take a look at the third method, double declining balance. This is called an accelerated method. The reason it's called an accelerated method is because it takes more depreciation in the earlier years and less depreciation in the later years. Okay, so remember, double declining, don't deduct. Okay, double declining, I'm going to make this red. Double declining, don't deduct salvage value. Okay, this is the only method that you don't subtract your salvage value or your residual value. Okay, you ignore it until you get to the end. Okay, all right, so here's our procedure. Find the straight line rate as a percentage. So you take 1 divided by estimated useful life in years. Okay, multiply that number times 2 to get your double declining balance rate. And then our depreciation each year is the book value at the beginning of the year times your double declining balance rate. All right, so now let's see how this works. So first of all, we need to find, we're going to do this. So we're going to find our straight line rate. So our straight line rate is equal to 1 divided by useful life in years. Right? 20%. Our straight line rate is 20% a year. Our double declining balance rate is double our straight line rate. So it's equal to 2 times our straight line rate. So our double declining balance rate is 40%. That's the rate we're going to use in our depreciation calculations. Okay, so annual depreciation is equal to book value at the beginning of the year. Now, in the first year, you haven't taken any depreciation. Your book value is equal to your cost. So it's cost times your double declining balance rate. Again, I need to fix my, let me fix my formatting. Okay, so our first year, 40% is our double declining balance rate. Our cost is 100,000. That's our book value at the beginning of the year. All right, our accumulated depreciation is 40,000. Our book value is equal to cost minus accumulated depreciation. Okay? Book value equals cost minus accumulated depreciation. Okay, now, depreciation expense in the second year. What is our book value at the beginning of year 2? The book value at the beginning of year 2 is book value at the end of year 1. So our book value at the beginning of the year is equal to 60,000. We're going to multiply that by our 40%. Our depreciation in our second year is equal to 24,000. Okay, our accumulated depreciation is equal to last year's plus this year's expense. And our book value now is equal to cost minus accumulated depreciation. Notice how quickly the asset's being depreciated. Remember when we did straight line? When we did straight line, our first year's depreciation was only 19,000. This is more than double that because we're not using the, remember we didn't use the residual value or the salvage value. Okay, year 3, our depreciation expense is equal to our book value from the prior year times our double declining balance rate. So it's 14,004. Put that over here. Okay. So again, our accumulated depreciation, last year's plus this year's expense, and our book value is equal to cost minus accumulated depreciation. All right, we're keeping an eye on this. We don't want to depreciate below salvage. Remember that our salvage value is $5,000. Okay? Okay, next up, year 4. Book value at the beginning of the year, 21,600. Multiply that by 40%. So our depreciation in year 4 is 8640. Our accumulated depreciation is now 87,040. Put this over here so we can see what our T account looks like. Okay, so now our book value is equal to cost minus accumulated depreciation. Okay? All right, so now let's come over here. Now remember, this cannot be below $5,000. I'm going to put 5,000. If you're doing this by hand in a class or on a test in a calculation, put this number here to remind you not to depreciate below that number. Okay? All right, so our expense is, we're going to test it. It would be this times 40%. That's 5,184. All right, so that's not going to bring us down to $5,000. So we're going to get rid of that. What we're going to say is we need the amount of depreciation that's going to bring us from 12,960 down to 5,000. So it's equal to 12,960 minus 5,000. Okay? This depreciation expense is equal to last year's book value minus the 5,000, which is our salvage value and our final book value. All right? So now our accumulated depreciation is our magic number of 95,000. Okay? And we're done. Now, with double declining balance, depending on how the numbers work out, sometimes you might be fully depreciated earlier than 5 years. So you really need to keep an eye on these as you go along. Don't just get into a rut. Of course, if you're doing this in Excel, it's very easy. You can drag your formulas across and it'll be very simple. But make sure you don't depreciate below the 5,000. What some companies do in real life is if it gets to be too fast, then they'll switch to straight line and they'll do straight line at the end. All right, so I hope that helps. We did straight line, we did an activity method, and we did double declining balance. So 3 different ways of recording depreciation. Any one of them is a legitimate way for a company to depreciate its assets. All right, I hope you found this helpful in your studies, and I'll see you in the next video.